Complete retirement risk. Masterclass. Retirement planning isn't just about saving enough money, it's about understanding and managing a complex web of risks that can derail even the best funded retirement. Today we're going to walk through every major risk category that retirees face, from the obvious ones to the subtle threats that most people never consider until it's too late. The first and most discussed risk is market risk, also called investment risk. This is the risk that your portfolio will decline in value at exactly the wrong time. During your working years, market volatility is your friend because you're buying shares at lower prices during downturns. But in retirement, when you're withdrawing from your portfolio, a sharp downturn early in retirement can permanently impair your wealth. This is known as sequence of returns risk, and it's the single most dangerous investment risk in retirement. Consider two retirees who both earn an average 7% return over 30 years with a 4% withdrawal rate. If the first retiree experiences strong returns in the first decade and poor returns later, their portfolio survives easily. If the second retiree gets the same returns in reverse order, poor returns first and strong returns later, their portfolio may run out of money by year 22. Same average return, radically different outcomes. The order of returns matters far more than the average. The primary defense against sequence risk is asset allocation. Holding 2 to 3 years of expenses in cash and short-term bonds creates a buffer that allows you to avoid selling equities during downturns. A bucket strategy, where you divide your portfolio into short-term, medium-term, and long-term buckets, is one popular approach to managing this risk. The second major risk is inflation risk. A dollar today will buy significantly less 20 or 30 years from now. At just 3% annual inflation, $100,000 of purchasing power today becomes equivalent to only $41,000 in 30 years. Healthcare inflation is even worse, averaging 5 to 7% annually, meaning medical costs could quadruple during a 30-year retirement. The defense against inflation risk is maintaining adequate equity exposure throughout retirement. Stocks are the only major asset class that has consistently outpaced inflation over long periods. Treasury inflation-protected securities, or TIPS, provide a direct inflation hedge for a portion of your bond allocation. Social Security's cost of living adjustments also provide partial inflation protection. The third risk is longevity risk, the risk of outliving your money. A 65-year-old couple today has a 50% chance that at least one spouse will live to 92 and a 25% chance one will reach 97. Planning for only average life expectancy means a coin flip chance of running out of money. Strategies to address longevity risk include delaying Social Security to maximize your guaranteed lifetime income, considering a single premium immediate annuity for a portion of your portfolio to create an income floor, and maintaining a dynamic withdrawal strategy that adjusts spending based on portfolio performance, rather than using a fixed dollar amount. The fourth risk is healthcare cost risk. The average 65-year-old couple retiring today will need approximately $315,000 to cover healthcare expenses in retirement, according to Fidelity's latest estimates. This includes Medicare premiums, supplemental insurance, co-pays, deductibles, and prescription drugs. It does not include long-term care costs, which are a separate and even larger risk. Medicare covers many healthcare expenses, but it doesn't cover everything. Dental, vision, hearing, and most long-term care services are not covered or only partially covered. Medicare Advantage plans and Medigap supplemental policies can reduce out-of-pocket costs, but they come with their own premiums and limitations. Health savings accounts funded during your working years can be a powerful tool for covering healthcare costs tax-free in retirement. The fifth risk is long-term care risk. The Department of Health and Human Services estimates that 70% of people turning 65 today will need some form of long-term care during their lifetime. The average nursing home costs over $100,000 per year, and a private room averages over $110,000. The median need for long-term care services is about 3 years, but a significant percentage of people need care for 5 years or more. Options for managing long-term care risk include traditional long-term care insurance, which has become expensive and difficult to obtain, hybrid life insurance, and long-term care policies that provide benefits for both, self-insuring by earmarking a portion of your portfolio specifically for potential care needs, and Medicaid planning for those with more modest assets. The sixth risk is tax risk. Tax rates can and do change. If you have the majority of your retirement savings in traditional IRAs and 401ks, you're exposed to the risk that future tax rates will be higher than today's rates. With national debt levels at historic highs and Social Security trust fund depletion on the horizon, Many experts believe tax increases are more likely than not in the coming decades. The defense against tax risk is tax diversification. Having savings across 3 tax buckets, taxable brokerage accounts, tax-deferred traditional IRAs and 401ks, and tax-free Roth accounts gives you flexibility to manage your tax liability regardless of what future rates look like. Strategic Roth conversions during lower income years can shift money from the tax-deferred bucket to the tax-free bucket at favorable rates. The 7th risk is withdrawal rate risk. The traditional 4% rule, withdraw 4% of your initial portfolio balance adjusted for inflation each year, was designed for a 30-year retirement with a 50-50 stock and bond portfolio. Recent research suggests that in today's lower yield environment, a starting withdrawal rate of 3.3 to 3.7% may be more appropriate for those wanting a very high probability of success over 30 years. Dynamic withdrawal strategies that adjust spending based on portfolio performance can allow higher initial withdrawal rates while maintaining safety. The guardrails approach, which increases withdrawals when the portfolio grows above a certain threshold and decreases them when it falls below another, has shown promising results in Monte Carlo simulations. The 8th risk is cognitive decline risk. Alzheimer's disease and other forms of dementia affect approximately 1 in 9 Americans aged 65 and older, and nearly 1 in 3 aged 85 and older. Cognitive decline can impair financial decision-making years before a clinical diagnosis. Retirees with diminished cognitive abilities are also more vulnerable to financial fraud and scams. Protective measures include simplifying your financial life as you age, consolidating accounts, automating bill payments, and reducing the number of financial decisions you need to make. Establishing a durable power of attorney and identifying a trusted family member or advisor who can step in if cognitive decline becomes apparent are critical planning steps. Consider a fee-only fiduciary advisor who has an ongoing relationship with your family. The 9th risk is behavioral risk, or the risk that your own emotions and biases will lead to poor financial decisions. We've discussed market timing, but behavioral risk extends beyond that. It includes the tendency to spend more in early retirement when you feel healthy and optimistic, the temptation to help adult children financially at the expense of your own security, and the difficulty of cutting spending when markets decline. The best defense against behavioral risk is automation and accountability. Automate your income withdrawals, automate your bill payments, and work with a financial advisor who serves as a behavioral coach. Studies consistently show that the greatest value advisors provide is preventing clients from making emotional financial decisions. The 10th risk is policy and legislative risk. Social Security benefits, Medicare coverage, tax rates, and retirement account rules can all change based on congressional action. The Social Security Trust Fund is projected to be depleted around 2034, at which point benefits may need to be reduced by approximately 23% if no legislative action is taken. Medicare similarly faces funding pressures that could lead to changes in coverage or costs. You cannot control legislative risk, but you can build a retirement plan that's resilient to potential changes. This means not being overly dependent on any single income source, maintaining flexibility in your spending, and staying informed about proposed policy changes that could affect your retirement. The 11th risk is housing risk. Your home is likely your largest asset and your largest expense. Housing risks include property tax increases, maintenance and repair costs that escalate as homes age, the potential need to modify your home for accessibility as you age, and the risk that housing values decline in your area. If you plan to use home equity as a retirement funding source through downsizing or a reverse mortgage, housing market conditions will directly impact your retirement security. The 12th and final risk is relationship risk. Divorce in retirement, often called gray divorce, has been rising steadily. A divorce can cut retirement assets roughly in half while maintaining many of the same fixed expenses. The death of a spouse also creates financial risk, as the surviving spouse loses one Social Security check, may face higher tax rates from filing as a single individual, and may need to replace services the deceased spouse provided. Now let me tie all of these risks together into a comprehensive risk management framework. Start with your income floor. This is the amount of guaranteed lifetime income you have from Social Security, pensions, and annuities. Your income floor should cover your essential non-discretionary expenses, including housing, food, healthcare, insurance, and utilities. If your income floor doesn't cover essentials, consider ways to increase it, whether through delaying Social Security, purchasing an annuity, or reducing fixed expenses. Above your income floor, build your investment portfolio to fund discretionary spending and legacy goals. Use the bucket strategy to manage sequence risk, Maintain adequate equity exposure for inflation protection, and employ dynamic withdrawal strategies to adapt to changing market conditions. Layer in your risk management tools adequate insurance coverage, including Medicare supplemental, long-term care or hybrid policies, and umbrella liability coverage. Estate planning documents, including wills, trusts, powers of attorney, and healthcare directives. Tax diversification across all three buckets. Finally, build in resilience through spending flexibility. The most resilient retirement plans have a significant portion of discretionary spending that can be reduced if markets decline, healthcare costs spike, or other risks materialize. Retirees who can reduce spending by 10 to 15% during difficult periods dramatically improve their probability of portfolio survival. Here is your risk management action plan. Step 1, assess your income floor and determine if it covers essential expenses. Step 2, stress test your portfolio withdrawal rate using Monte Carlo simulations at various return scenarios. Step 3, review your insurance coverage, including Medicare supplemental, long-term care, and umbrella policies. Step 4, ensure your estate documents are current and that a trusted person can step in for financial management if needed. Step 5, evaluate your tax diversification across taxable, tax-deferred, and tax-free accounts. Step 6, build spending flexibility into your budget with clearly defined essential versus discretionary categories. Retirement is not a financial event. It's a 20 to 30-year journey through an unpredictable landscape. The retirees who navigate it successfully aren't necessarily the ones with the most money. They're the ones who identify the risks, build defenses against them, and maintain the flexibility to adapt when the unexpected happens.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.